Let me share with you the top 10 tax credits for individuals and families. Welcome back, folks, to another edition of the Awesome Sweet Curious Show. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about the top 10 tax credits for individuals and families. But first, let me just break down to you the difference between a tax deduction and a tax credit. A tax credit is a dollar for dollar reduction in your actual tax bill. So a few credits are even refundable, which means that if you owe, say, $250 in taxes but qualify for a $1,000 credit, you'll get a check for $750. Most tax credits, however, are not refundable. So a tax credit is kind of different from a tax deduction, which is a dollar for dollar, which is a dollar amount the IRS allows you to subtract from your adjusted gross income, your AGI, making your taxable income lower. So the lower your taxable income, the lower your tax bill, right? So either way, as the simplified example, let me just show you on the screen right now. If you look on the screen right now, I'm showing you a very simplified example of the impact of a $10,000 tax credit, how that impact is much bigger than a $10,000 tax deduction, right? You can see it there. Okay, so let's first talk about the tax credit for people with kids. Number one, we have the child tax credit. This could get you up to $2,000 per kid and $500 for a non-child dependent. So the higher your income, the less you'll qualify for though. So for the 2020 tax year, you may qualify for the credit only if your modified adjusted gross income is under $400,000 for married filing jointly and $200,000 for everybody else. How much do you get per child? The child tax credit offers up to $2,000 per qualifying dependent child age 16 or younger at the end of the calendar year. So there is a $500 non-refundable credit for qualifying dependents other than children. This is a tax credit, folks, which means that it reduces your tax bill on a dollar for dollar basis. Up to $1,400 of the child tax credit is refundable. That is, it can reduce your tax bill to zero and you might be able to get a refund on anything left over. How do you qualify? To qualify for the child tax credit, your modified adjusted gross income has to be, as I said earlier, below $400K for married filing jointly or $200K for everybody else. Some of the other child-related eligibility requirements for the child tax credit include that you must have provided at least half of the child's support during the last year, and the child must have lived with you for at least half of the year. There are some exceptions to this rule, and the child cannot file a joint return or file it only to claim a refund. The child has to be 16 or younger by the end of the calendar year, and this is kind of very important. What's kind of cool is that most tax software will lead you through the process and calculate the credits for you. Number two, we have the child and dependent care credit. Now, generally with this credit, it's 20 to 35% of up to $3,000 of child care and similar cost for a child under 13, an incapacitated spouse or parents, or another dependent, so you can work, and up to $6,000 of expenses for two or more dependents. All right. And the thing here is that the percentage of allowable expenses decreases for higher income earners, and therefore the value of the credit also decreases, but it never disappears completely. And this credit is not refundable, which means that it can take your tax bill down to zero, but you don't get the leftovers. And payments made out of a dependent care flexible spending account and an FSA or other tax advantage program at work may reduce your credit. And this is now to qualify for the child and dependent care tax credit, You got to have a dependent child must be 12 or younger at the time the child care is provided. Spouses and other dependents don't have an age requirements, but IRS rules say that they must have been physically or mentally incapable of self-care and must have lived with you for more than half the year. If you're married, you must file as married, filing jointly. You must have earned income, so in other words, money you earn from a job, because investment or dividend income does not count. You must provide the care provider's name, address, and taxpayer identification number, either a social security number or an EIN, an employer identification number. And you cannot claim the credit for payments to care providers who are your spouse, a parent, or a parent rather of the dependent child, a dependent listed on your tax return, or your child who is age 18 or younger, even if they're not listed as a dependent on your return. So this is kind of very important, folks. One thing I want to say also here is that you got to keep in mind though that qualifying expenses can go beyond physical care and extend to the household expenses, such as paying someone to help with cooking and cleaning. The idea here is that the authorities are trying to, quote unquote, reward you through the credit, to reward you for services that you did. You took care of somebody, you took care of a child, you took care of an adult dependent, and you have to make sure that it has to be within a certain number of categories, and it has to surround physical care, emotional care, financial care, and so on and so forth. Number 3, the earned income credit. So this credit will get you between $538 and $6,660 in tax year 2020, depending on how many kids you have, your marital status, whether you're married or not, and how much you make. So let's say if your AGI, your adjusted gross income, is less than about $57,000 in 2020, it is something to look into. Though if you had more than $3,650 of investment income, dividends, capital gains, or a few other things in 2020, you will not qualify. Now, note though, folks, that you can get up to $538 in 2020 for the earned income credit, even if you don't have kids. Very important, though only if your income is less than $15,820 as a single filer, or $21,710 if you are filing jointly. Now, what is the earned income tax credit? Is specifically designed to benefit working people with low incomes. So I'm showing you right now on the screen right now. I'm showing you the maximum credits and the maximum income allowed before losing the benefit. So you can see here that this is the 2020 earned income tax credit for taxes due in April 2021. You can see the maximum earned income tax credit based on the number of children you have, and also the maximum earnings single or head of household filers, and the maximum earnings for joint filers, right? And I'm showing you right now also as a comparative, in a comparative approach, I'm showing you what the numbers were in 2019. So to qualify for the earned income tax credit, which is very important, you have to file a tax return to get the credit, even if you don't owe tax and are not legally obligated to file a return. So this tax credit is refundable. In other words, so if you're due to receive a credit of $5,000 but you owe only $2,000 in taxes, you might get a check for $3,000. And the great thing here is that a number of states offer some versions of an earned income tax credit for working families, so you might be able to get that credit too, including in New York and Connecticut. And the great thing here is that if you're not familiar with the taxes, most tax software will lead you through the process and calculate the credits for you. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a conversation today around the top 10 tax credits for individuals and families. So number 4, you have the adoption credit. So this for the 2020 tax year, this covers up to $14,300 in adoption costs per child. In 2021, it rises to 14,440. So the credit in 2020 though, the credit begins to phase out at 214,000, about 215,000 of modified adjusted gross income, and people with AGIs higher than $255,000 don't qualify. Right? And also, you cannot take the credit if you are adopting your spouse's child. Okay, so people who adopt special needs children can get up to the full credit even if their actual expenses were less. Let's talk about tax credits for big tickets green purchases. So the residential energy tax credit and the plug-in electric drive motor vehicle credit. Now the residential energy tax credit is kind of cool because it gets you up to 26% of the cost of solar energy systems, including solar water heaters and solar panels. And the one thing you have to understand though is that the credit dwindles to 22% in 2021. So everything from residential renewable energy tax credits, you have renewable energy tax credit details in terms of what the IRS considers allowed. You can go to the IRS website or to the United States Department of Energy to see if you qualify. And we also have non-business energy property tax credit. And this has been extended through December 31st, 2020. So everything from home insulation, exterior doors, exterior windows and skylights, certain roofing materials. The second category of eco-friendly appliances, I'm talking about electric heat pump water heaters, central air conditioning systems, natural gas, propane or oil water heaters, stoves that use biomass fuel, natural gas, propane or oil furnaces, natural gas, propane or oil hot water boilers, advanced circulating fans for natural gas, propane and oil furnaces. So this is kind of cool, right? And you can claim a tax credit for 10% of the cost of qualified energy efficient improvements. And first, there are some limits. So you have $200 for windows, $50 for a furnace circulating fan, $150 for a furnace or boiler, and $300 for a single residential energy property. You also have the plug-in electric drive motor vehicle credit, and you can get up to $7,500 for buying a plug-in electric vehicle. And the IRS requires that the car have at least 4 wheels and can be propelled to a significant extent by a rechargeable battery with a capacity of at least 4 kilowatt hours. And the minimum credit is $2,500, but rises depending on the battery capacity. You must buy the car new because used car don't count. Number 7, we have a tax credit for investing in education, for health, or for retirement. So let's talk about the Savers Credit. This runs 10% to 50% of up to $2,000 in contributions to an IRA, a 401k, a 403b, or certain other retirement plans. And this is $4,000 if filing jointly. So the percentage depends on your filing status, really, folks. And it also depends on your income. But generally, it is something to look for if your AGI in 2020 is less than $65,000 if married filing jointly, $48,750 if head of household, and $32,500 if single. And actually, the Savers Credit is also called a Retirement Savings Contribution Credit. It's a tax credit worth up to $1,000, $2,000 if married jointly, and this is for mid and low income taxpayers who contribute to a retirement account. And you are eligible for the Savers Credit if you are 18 or older, not a full-time student, and not claimed as a dependent on another person's tax return, right? So, but that does not necessarily mean that you get it, because you must also make a retirement plan or IRA account contribution and fall under maximum adjusted gross income caps the IRS sets each year. So we're showing you right now on the screen. You can see on the screen right now. So if your adjusted gross income is above any of this threshold, you're not eligible for the Savers Credit. So you have a 65,000 as a married filing jointly as a married joint filer in 2020, 66,000 in 2021, 48,750 as a head of household filer in 2020, 49,500 in 2021, and 32,500 as any other filing status in 2020, and 33,000 in 2021. So you're not eligible for the savers credit if you are above those thresholds. So this is kind of important, folks, and we're showing you right now on the screen the savers credit rate for 2020, so you can see that 20% contribution, 10%, 20%, 10%, 20%, 10% when it comes to whether, depending on where your AGI stands. Now, unlike many IRS rules, the math when it comes to calculating the savers credit is fairly simple. So the credit is worth 50%, 20%, or 10% of a maximum contribution of $2,000 or a total of $4,000 if you're married filing jointly. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We're also having a conversation about the top 10 tax credits for individuals. And number 8, we have the American Opportunity Credit. Now, this credit runs up to $2,500 per student for tuition, activity fees, books, supplies, and equipment during your first 4 years of college. First 4 years. After that, it's gone. Phases out. The student must be enrolled at least half-time and cannot have any felony drug convictions. And the credit phases out with income, so you may not qualify if your adjusted gross income is higher than $90,000 as a single filer or $180,000 as a joint filer. So parents can take the credit if they qualify and claim the student is dependent on their return. Now, let me just kind of tell you how this works. You could lower your tax bill by up to $2,500 if you paid that much in undergraduate education expenses last year. The American Opportunity Tax Credit will let you claim all of the first $2,000 you spent on tuition, books, equipment, and school fees, but not living expenses or transportations, plus 25% of the next $2,000 for a total of $2,500. And who can claim it? Now, the American Opportunity Credit is specifically for undergrad college students and their parents. You can claim the credit on your taxes for a maximum of 4 years, and your parents will claim the credit if they paid for your education expenses and you are listed as a dependent on their return. And you can get the full education tax credit if your modified adjusted gross income, or MAGI, was $80,000 or less in 2019. $160,000 or less if you file your taxes jointly with a spouse. All right. Now, this is the kind of what I just want to say here is that the American Opportunity Credit cuts the amount of taxes you pay. It's a credit, right? And the thing is that it is a credit that is refundable. In other words, you can still receive 40% of the American Opportunity Tax Credit's value up to $1,000. Even if you earned no income last year or owe no tax. All right, let me give you an example. Let's say if you qualify for a refund, this credit could increase the amount you would receive by up to $1,000. This is why the American Opportunity Credit is typically the best education tax break for students and their families, hands down. But again, here the main condition is that this only applies to the first 4 years of college. This is not like the next credit, the lifetime learning credit. It's totally different. Speaking of the lifetime learning credit, with this credit, you can get up to $2,000 for tuition, activity fees, books, supplies, and equipment for undergrad, grad, or even non-degree courses at accredited institutions. As the name says, lifetime learning. All right. So unlike the American Opportunity Credit, there is no workload requirement. So the $2,000 limit is per return, not per student. So the most you can get back is $2,000 regardless of how many students you pay expenses for. This is an important distinction here. And this credit also phases out with income. So you may not qualify if your modified adjusted gross income is higher than 68,000 as a single filer or 136,000 as a joint filer in 2020. In 2021, the thresholds are 69,000 for single filers and 139,000 for joint filers. You can claim both the American Opportunity Credit and the Lifetime Learning Credit on the same return, but you cannot claim both for the same student. All right. So one thing that I want to say here is that you can claim 20% of the first $10,000 you paid toward tuition and fees in 2020 for a maximum of $2,000. Like the American Opportunity Tax Credit, the Lifetime Learning Credit does not count living expenses or transportation as eligible expenses, but you can claim books or supplies needed for coursework. And the Lifetime Learning Credit is not just for undergrads or their parents. That's the cool part. That's the cool thing about it. So the credit applies to undergraduates, graduate, and non-degree or vocational students, and there is no limit on the number of years you can claim it. So if you really think about it, it's kind of cool for graduate students or anyone taking classes to develop new skills, even if you already claimed the American Opportunity Tax Credit on your taxes in the past. Note though that you cannot claim both the American Opportunity Credit and the Lifetime Learning Credit in the same year. This is really important. And I also want to say that the Lifetime Learning Credit is not refundable. It's not. You cannot receive the Lifetime Learning Credit as a refund if you earn no income or owe no tax. And if you this is the difference, really, if you think about it, between the American Opportunity Credit and the Lifetime Learning Credit. Number 10, the last but not the least, the Premium Tax Credit. This is a tax credit you can use to lower your monthly insurance payment called your premium when you enroll in the plan through the health insurance marketplace. Your tax credit is based on the income estimate and household information you put on your marketplace application. So if your estimated income falls between 100% and 400% of the federal poverty level for your household size, you qualify for a premium tax credit. You can use all, some, or none of your premium tax credit in advance to lower your monthly premium. If you use advance payments of the tax credit, then you qualify. If you use more advanced payments of the tax credit than you qualify for based on your final yearly income, you must repay the difference when you file your federal income tax return. And if you use less premium tax credit than you qualify for, you will get the difference as a non-refundable credit when you file your taxes. You can buy health insurance through other sources though, but the only way to get a premium tax credit is through the health insurance marketplace. All right, folks, this is it for today. I really appreciate your attention. Let me quickly recap today's conversation. What are the top 10 tax credits for individuals and families out there? Quickly recap here. Number 1, we have a child tax credit. So first we have the tax credit for people with kids. So the child tax credit, the child independent care credit, the earned income credit, the adoption credit. And then we have the tax credits for big ticket green purchases. So you have the residential energy tax credit and the plug-in electric drive motor vehicle credit. And then we have the tax credit for investing in education, for health, or for retirement. So we have the Savers Credit, the American Opportunity Credit, the Lifetime Learning Credit, and the Premium Tax Credit. I will see you next time, folks. But until then, remember, stay marvelous.